and welcome to Morning Markets. I'm Lindsay Biscaya. Here's some of the stories we are tracking for you in the BNN Bloomberg newsroom. The United Arab Emirates has committed to investing $70 billion in Canada. Now, the investment will be in vital sectors, including energy, artificial intelligence, logistics, and mining. The announcement comes on the heels of Prime Minister Mark Carney's visit to Abu Dhabi to strengthen bilateral trade. Carney also says Ottawa is finalizing a $1 billion project aimed at expanding Canada's critical minerals processing capacity. Shares of Gap are moving higher after the retailer reported a beat in sales and profit in its most recent quarter. CEO Richard Dickson says celebrity collaborations as well as marketing have attracted higher income consumers and have helped to boost same-store sales. The new initiatives, along with a revamped inventory, have also allowed Gap to raise the price of denim and sell more products at full price. And shares of Ross stores are rallying. The discount retailer posted profit and revenue in its latest quarter that exceeded estimates and saw a spike in same-store sales. Ross also boosted its full-year profit forecast by more than expected. Analysts are also highlighting strength in its women's fashion brands as a positive going into the holiday season. Take a quick look at the markets this morning. The TSX trending a little bit down today. We're seeing most of the markets rebounding ever so slightly. If we take a look at the U.S. markets, after some sharp sell-off this week, they were rebounding. There you go. The S&P 500 up, or not up. It's flat at the moment. Dow Jones up ever so slightly, and the NASDAQ is down at the moment. Global markets have come under pressure this week. Yesterday, stocks took their biggest hit since April. And for his analysis, we sat down earlier this morning with Barry Schwartz, partner and portfolio manager at Baskin Wealth Management.
April was a special case, of course. That was no idea what these tariffs would bring, how impactful they would be. I think the result is what people expected. We have no clarity whatsoever, and we're seeing some of these tariffs pull back. Of course, the market has been straight up since April, and no one really can complain with the S&P, the NASDAQ, the TSX, all well more than double digits heading into November. So a pullback's going to happen. We're having a pullback here really on market sentiment and on vibes, not on earnings, not on interest rates, not on inflation. And that's going to happen. I love pullbacks when markets pull back on really no news, right? Because that's where the opportunities lie. As a long-term investor, I'm looking to buy companies where their intrinsic value may not have been impacted by any news whatsoever, but the stock prices come off. And so that provides you with opportunities. Unfortunately, I haven't had one client call me up and say, I want to give you more money right now. This is what people should be doing. Every pullback, every market opportunity provides you with good valuations. And this is the market we're seeing right now. Will it fall more? Nobody knows. Not much news.
Do you agree, though, that the fall we are seeing is potentially due to investors kind of watching and knowing that we're not going to see more rate cuts next month? Where do you think most
of I think there's one of the Fed Reserve people said today that they still see potential for a December rate cut. And that's what popped the futures in the last few minutes, right? So who knows exactly what's going to happen with interest rates in December, but I think it's very clear over the next year or so the United States will be aggressive cutting interest rates. They totally get it. Interest rates are way too high in the United States. No one can move. It's choking business investment. if we didn't have this AI data center build out boom, the U.S. economy would be looking really, really horrible. So we're expecting significant rate cuts in 2026. Canada's already done the heavy lifting. There may be some more, but I think that's going to lead to strong markets in 2026. That's our expectation.
I want to talk about crypto because that's a big story as well this week. But first of all, just the S&P 500 fallen more than 5% since that peak in April.
Yeah.
You say this kind of makes sense. Like, what are you watching at the S&P 500?
On S&P 500 or crypto?
On S&P 500.
Yeah. Well, so the S&P 500 is just a natural pullback. I mean, if you put everything in context, 3 great years in a row for the S&P 500, right? Double digits in 2023, 2024, and 2025. That's extraordinary. So markets, there's a lot of high expectations in market valuations right now. I totally get it. You look at the valuations of a lot of companies are trading at unreasonable values. You look at a lot of speculative stocks, they're trading on hot air. And as a result, this Bitcoin, which there's nothing really behind it, it's a trading vehicle, it makes sense that it's fallen, right? People are scared right now. The sentiment is negative. There are your opportunities. I'm never going to recommend anybody go out and buy Bitcoin, but if you liked it at 110,000, maybe you'll like it better at 83,000.
Yeah. Okay. So let's talk about Bitcoin then. I mean, like it is falling. What's the significance of just how much just how much we've been seeing it drop, just in the past even week?
Nobody likes it. No. So this is the case with investing, right? In the short term, when it goes up, everybody loves it. When it goes down, you can come up with a narrative why everybody hates it. The problem with Bitcoin is how do you value it, right? So you're talking to an old school guy here who uses fundamentals to value companies based on the cash flows that I think they're going to deliver in the future. There's no cash flows that Bitcoin delivers. It's a commodity. It's no different than baseball cards or gold or, I don't know, whatever you want to, that doesn't deliver cash flows, art, for example. So it's only worth what the next person's going to pay for it. Very hard to value. And if you're going to buy this kind of thing, you have to be prepared for enormous volatility. You haven't had it recently, and this is scaring people, but that's what Bitcoin has done since it was started.
It's pretty controversial. Yeah. Do you think it's a good time to get in? If we're seeing anything dropping this low, is that always a good time to buy, or it just depends on what you're looking at?
Crypto?
Yeah.
You're asking the wrong person. It's a good time to buy great quality companies that you think are going to grow at double-digit rates. If you think the U.S. economy is going to be okay, if you think interest rates are going to fall, if you think corporate earnings like we do are going to grow at double-digit rates, now's the time to start looking at some attractive U.S. and Canadian, North American companies.
You mentioned off the top, earnings. At least, most earnings looking pretty strong this week. We got a lot of retail earnings in this week. Gap coming out today. Walmart yesterday. Is there anything that's been catching your eye? Anything specific? Yeah,
so this has been an economy where the rich are spending, and those are the rest of the population is affected because everything is so expensive, right? And so that's hurting some low-end retailers, low-end restaurants, and we've seen in the stock prices because interest rates are so high. You're seeing home building stocks and ancillary building services really beaten up, and those won't recover until interest rates start to come down in the U.S. and when there's more clarity on trade and tariffs. We're already seeing the U.S. back off on a lot of these dumb tariff ideas, and I think that will add more certainty to the market as we go into 2026.
That was Barry Schwartz, partner and portfolio manager at Baskin Wealth Management. Up next, shares of Altus Group are up today after unveiling its value creation plan at its Investor Day event. And we will talk about that with its incoming CEO and executive chair, Mike Gordon. That's coming up after the break. Altus Group hosted an investor day in New York yesterday with the main focus on its value creation plan. The commercial real estate intelligence provider outlined new goals, including a dual listing in the U.S. market. Here to talk about that is Altus Group's incoming CEO and executive chair, Mike Gordon. It's good to have you, sir. Hey. Thanks for taking the time.
Good to be here.
I think just before we get into the creation plan that was unveiled yesterday, for maybe our viewers who don't know exactly what Altus Group does, can you tell us a little bit more about the company?
Yeah, sure. We provide data, software, analytics, and expertise services to commercial real estate companies, to whether it's the brokers, whether it's the funds, whether it's banking. We actually are we do all the valuation for more or less in North America and around the world for these assets. And so we have a really good insight into this asset category.
Okay, let's get into it then, because at this event yesterday, at this Investors Day, Altus says it's looking at a dual listing entering the U.S. market. Tell us how that's going to work and kind of the time frame for that.
So we're looking at that in 2027. So you would ask, why are we announcing that now while we're looking a year out? So there's a lot of work that we're doing with the business. Currently, about 60% of our revenue comes from the U.S. market. And additionally, as we go forward, we're also trying to simplify our portfolio. We have been put together over years through a lot of different acquisitions in and around services, in and around the data, in and around the analytics. And what we're doing right now is we've been working to simplify that portfolio and really focus on two core assets. One is the Argus Intelligence platform for commercial real estate. And the second one is our valuation advisory services, in which we have some of the best experts in the world who are trusted advisors to these funds and how we go ahead and give a valuation for each one of these assets. So with that, we're going to be focusing on that in the 26 timeframe, with the idea in 27 that we will then do the dual listing.
Let's talk a little bit more. You mentioned the Argus Intelligence and your focus on Argus Intelligence. What is that?
So it is a combination of three things. We have a software engine that basically does the valuation and does the calculations on any kind of real estate asset that would be out there, whether it is a office building, a hotel, whether it is a multifamily listing, or whether it's a warehouse. So we have that engine working on that. The second thing that we bring up through there on the intelligence side is we bring the data in there so that you can actually start looking at your portfolio and start identifying how is your portfolio doing, with the idea that we can also give you the benchmarks to that portfolio through that information. And now what we also showed yesterday is we showed the new analytics that we're listing. I'm an old analytics guy, and I know I should probably use the term AI, but we did show yesterday how our AI engines and agents would work to our investors yesterday, so that they can see what we're bringing into market now and into 2026.
So that's really the focus, it sounds, going forward. Correct me if I'm wrong, that kind of that artificial intelligence, the Argus Intelligence, and trying to ramp that up in the future?
It is. And for us, it's like really bringing all three of those things to the market, including the advisory services that I talked about earlier, as well as really starting to hone that market in North America, but also look for opportunities to grow that market in Europe and in Asia as well.
Your company also looking to accelerate the buyback of shares. What's the reasoning behind that?
Well, I think we feel like we're the best asset in commercial real estate right now. A couple years ago, as we started simplifying our business, we got rid of our tax business, and that was done, and we had a good amount of cash on our balance sheet. And quite frankly, as we've been looking around at things that we would want to invest in, we came back, talked to our investors, us as a board, we sat back and said, you know what, our best investment is in us. So we decided that we would accelerate that plan, really starting next week and going into next year.
Also at the Investor Day yesterday, your company has a lot of new things going on. You're also focusing on becoming a Rule 40 company. That's one of your goals for 2027, I believe. So can you talk a little bit more about how you're planning to get there?
Yeah, so I think, we did make quite a few announcements yesterday. It's kind of a good Investor Day when you do that. So we're doing it in twofold. One is we are going to be a company that we want to get to double-digit growth in our core areas. We think we'll be at high single digits soon enough. But really what we're doing is we're simplifying the business. We feel like we're going to really rationalize our cost model. And we really feel like that our EBITDA numbers will be, north of 30% very quickly in the 2026 timeframe, with the idea that, like, as we start introducing these new products and the add-ons, we'll see that growth happen really quickly thereafter.
You must have some challenges that you're going to try to have to deal with over the next couple of years, right? Like, commercial real estate is not without its challenges, that industry. What are some of the biggest kind of headwinds you're facing?
Yeah, and I said this yesterday, and I may regret it with the investors in the room, but I try not to let the team think that the market's going to be an issue for us. As a software company and a data and analytics company, our job is to provide solutions that will be great in markets that are thriving or in markets that have headwinds. So from our view on things, I think that what I look at in the industry, if there's anything, forget the market, is that sometimes you have longer adoption cycles. And so especially for some of these new products, we had a couple of customers speak yesterday at our event, and they're excited for the AI, but they'll admit that they're like, I'm a property guy for the last 25, 30 years, and they're very excited about it, but that we have to help them figure out where that comes. So I think that as the team has been working through this, and we've sat down and talked to our customers, we have kind of mapped very closely where this stuff will happen. It's very easy to talk about analytics and AI, but we're also showing them quantitatively where they should be able to get the value for this. So if we get that right, I think we can overcome those headwinds.
Okay, that's all the time we have, but appreciate you joining us, sir. Thanks so much.
Thanks for having me.
That was Altus Group's incoming CEO, Mike Gordon, joining us live. Coming up, Ottawa is pressuring Anglo American for more before approving the takeover of Teck Resources. We'll find out more about that right after the break. Stay with us. Sources are telling CTV News that Alberta and Ottawa are close to a pipeline agreement, but approval from BC and Indigenous groups remains the key challenge. CTV's Annie Bergeron-Oliver has more in this report.
The oil pipeline Alberta Premier Danielle Smith has been pushing for could soon be one step closer to reality.
We know that we've got a little bit more work to do on the technical side to be able to submit our pipeline proposal for consideration to the Major Projects Office. We've targeted the spring on that.
And when that happens, Ottawa is likely to be on board. Sources say a memorandum of understanding between the Premier and the Prime Minister is coming down the pipeline. As part of that deal, sources say Ottawa is considering easing a BC North Coast tanker ban, lowering or removing the emissions cap, and strengthening the industrial carbon tax to bolster carbon capture.
An MOU can be directionally, we would like to do this, and it can help thaw the ice on other issues like the emissions cap, but I'm not sure that anybody should bet on a pipeline happening anytime soon.
Many First Nations and BC's Premier hope a new pipeline never gets built. If Ottawa makes changes to the tanker ban as part of this deal to make it happen, David Eby fears major energy projects underway in his province could get scrapped.
For them to be able to go ahead, we need the support of coastal First Nations. It is fragile. They are not enthusiastic about these projects, but they're willing to tolerate them in exchange for protecting the coast from a heavy oil spill.
Ottawa says it wants BC's backing, but also has suggested it doesn't need it.
BC will be consulted, but BC doesn't get a veto because, as I've said, jurisdictionally, a pipeline that crosses more than one province is in the federal bailiwick.
The energy minister says talks with Alberta are constructive and that Ottawa will have more to say in a few weeks.
That was CTV's Annie Bergeron-Oliver. Bloomberg News is reporting Ottawa is pressuring Anglo American to make stronger commitments to executive and management jobs at its proposed Vancouver base as a condition for taking over Teck Resources. So for more on the story, we're joined by Jacob Lawrence of Bloomberg News. It's good to see you. Thanks for joining us. So what's the latest in terms of what the Canadian government is asking for here?
Yeah, so the latest that we've reported is that the Canadian government, specifically Minister Mélanie Joly's office, has been pushing Teck and Anglo to up their commitments to the country should this merger be approved. Bear in mind that the minister has the ability to approve or veto this merger through the Investment Canada Act. That's within her jurisdiction. And so it gives her department quite a bit of leverage to make specific asks of the company. In order to approve this deal. So what we've been reporting is that as of late, Joly has been asking for more commitments around the company's proposed headquarters, which would be in Vancouver, as well as some interesting commitments around the metals that the company is producing. So both Teck and Anglo produce a lot of copper, and Teck produces a lot of zinc, as well as some byproducts. Canada has been quite interested in stockpiling this minerals, which they see as really key to the economy and national security. And they've proposed in these negotiations with Teck and Anglo some interesting ideas around potentially stockpiling some of this metal that Teck and Anglo owns by purchasing offtake agreements to the companies. This is one idea that's been floated. Again, these negotiations are sort of subject to change. They've been evolving pretty rapidly, but that's the latest that we've been hearing.
Yeah, and in your report on Bloomberg, you say that the government also wants to ensure that Anglo-Teck would support the critical minerals strategy of Canada and the G7. I know you touched on that very briefly. Any sense at this point in terms of whether the company will actually comply with the demands of the federal government?
Too soon to tell, but I think these are asks that both Anglo and Teck are taking seriously. I mean, they know that they need the approval of the Canadian government in order for this deal to go ahead. And so I think they're trying to be cooperative and they're trying to be amenable. That's certainly what we've been hearing from our sources. There haven't been any asks that have been too tall for them to really consider from what we've heard. And so I think, these asks so far have been within the realm of reason for them.
Okay, that's Jacob Lawrence of Bloomberg News joining us live. Jacob, thanks so much for that. Appreciate it. The Montreal Economic Institute says the introduction of a new system for air passenger compensation being studied by the Canadian Transportation Agency that it argues would ultimately raise their operating costs and raise ticket prices and hurt the competitiveness of Canada's airline companies. So for more, we were joined earlier by CTV's Scott Hurst.
Flight delays, they can not only be annoying, but they can potentially cost us money with the impact of cancellations later and the knock-on effect that could have, whether it's business travel or personal travel. It can cost you money. Now, right now, under the current framework, Roger, if a flight is significantly delayed or canceled for reasons within the airline's control, it must do several things: provide assistance first and foremost, offer alternative arrangements or a refund, and pay compensation for the inconvenience. And passenger compensation applies when the cause of the disruption can be linked to that airline. In other words, there's no fault if the cause is outside the company's control. Now, these amendments would then make compensation mandatory for all disruptions unless that disruption is under a very specific set of so-called exceptional circumstances. And the proposed amendments would ultimately impose a greater burden of proof on the airline, Roger, in addition to reimbursement.
Okay, and now this is great for the customers, but what kind of an impact could it have on them as well, a negative impact?
Yeah, that's the argument from the Montreal Economic Institute, the Canadian think tank, out with a warning saying it could mean heavier regulatory burden and potentially higher ticket prices, likely to raise the number of cases of compensation, increase in operating costs and financial charges for that airline, potentially passing that on to the consumer. And ultimately, they argue it could reduce regional service. Some remote destinations could be deemed too financially risky. Now, of course, we know air passenger rights advocates have long been pushing for changes to give the passengers much more control, including beefed up compensation for delays, cancellations, and other disruptions, Roger.
And where are we in the process? Is this close? Is it still months, years?
Yeah, it's still being under consultation at the moment, as these changes are still in the proposed stage. And, this is something that, if it comes into effect, no doubt we'll get a lot of passengers wondering what it might mean specifically for them.
That was CTV's Scott Hurst reporting for us. After the break, we will get some analysis of the latest Canadian retail sales data. Stay with us. That's next. The United Arab Emirates has committed to investing $70 billion in Canada. The investment will be in vital sectors including energy, artificial intelligence, logistics, and mining. The announcement comes on the heels of Prime Minister Mark Carney's visit to Abu Dhabi to strengthen bilateral trade. And Carney also says Ottawa is finalizing a $1 billion project aimed at expanding Canada's critical minerals processing capacity. And shares of Dye & Durham are surging today. The legal software company has confirmed an unsolicited bid from Plantro. Dye says its strategic committee has received a conditional and non-binding proposal, and it's currently under review. Bloomberg reported earlier that Plantro's bid to take Dye & Durham private is valued at $384 million and proposes to pay over double Dye's closing price on Thursday. And consumer spending across the country slowed in September. Data from StatsCan shows retail sales fell 0.7% compared to the month prior. Sales were dragged lower by a drop in receipts at auto and parts dealers, with vehicle sales seeing their first decline in 3 months. Meanwhile, consumers spent more at food and beverage retailers. And in a flash estimate, StatsCan predicts retail sales were flat in October. Take a quick look at the markets now. The TSX is up at the moment by 0.3%. The market's rebounding ever so slightly after dropping this week. We saw lows we haven't seen since April, but you can see U.S. markets all trending up at the moment. The S&P 500 at 0.4%, Dow Jones at 0.7%, and the NASDAQ is at 0.2%. Okay, for more now on the retail sales report, we were joined by Dominic Lapointe, Director of Macro Strategy with Manulife Investment Management.
Widely expected, since now StatsCans provide an advance estimate. So even a month ago, we knew this would be a weak print, but 6 out of 9 categories dropped in September. And you can see on the people looking at the terminal that the core number is slightly positive, but that's mainly because gas spending went up, which isn't a very cyclical industry in most contexts. So overall, it's a weak month. And it's also a weak quarter. With September now, we have a good idea of how Q3 went. And it's a significant slowdown from Q1 and Q2. And again, in the current economic context, it shouldn't surprise viewers of the show.
Is this tariffs now fully biting, or is this the economy?
I think it's both. I think we could split Canadian consumers now in sort of 3 categories. You have people that still have their employment. They've had decent or modest wage gain, so they're able to engage in the economy, spend more on discretionary items, buying a car, etc. Then you have people with, I'd say, moderate to lower income, and they're the people that are usually not engaging as much. They're still spending, but they're still spending on staple, and they're prudent into how they spend, and that we could tie it back to high interest rates, the high price for goods and services. Inflation slowed down, but goods are still expensive. Mm-hmm. And then you have a third category, which are the households that were directly or indirectly impacted by tariffs in the cities and in the regions where they've hit. And these people, obviously, they're going to be more careful about their spending. So in the end, you still have some consumption going on at stores, but there isn't a lot of pricing to be increased there.
Do you have a breakdown on those 3 groups? Is there any way to break down percentage-wise what those numbers are within the country, or no?
We don't. So, but if you read it's surveys from the Bank of Canada, a survey of Canadian financial consumer, then you realize is that when you ask them the question, how many people are holding back on spending, based on the context, it's 50%. 50% of Canadians. And in between those 50%, when you ask them why, they're going to cite high interest rate, they're going to say high price of goods and services, and also high housing costs. So obviously the other 50% that are saying they're not holding back on spending, we could assume that they're working in industries that are impacted by tariffs, mm-hmm. or industries that overall their absolute level of wages is enough so that they can afford past inflation and still engage and still buy.
Now, I was looking at discretionary retail sales up 3% for the year. Is that first group, do you think, that's driving that you mentioned?
Not entirely, but we would assume that yes. And I'd say it's a different phenomenon than what we see in the U.S., right? In the U.S., there are more surveys that we have access to, and in fact, people that report lower income, their lower quintile of income, are planning to spend more in percentage term than people with higher income. So I think Canadian consumers in general are slightly more cautious than American ones, which also leads to the fact that our savings rate now, national savings rate, is as close as the U.S. While before, back a couple of years, it was lower.
And just focusing on going back to the sectors, automobiles taking, I think, was it the biggest hit that automobiles took?
Yes, last month, automobiles put downward pressure on retail sales. In fact, sales for automobiles are down for the year. What we saw, I think, is post-pandemic, a big backlog into demand for cars. There were a lot of issues getting cars into the country. Then prices rose, and people that wanted to buy a car actually were able to. And now we're seeing the inverse impact of that backlog, which is that demand is a little bit lower. Prices are still high, and interest rates to finance and auto loan are still somewhat elevated. So the demand is lower for new motor vehicle sales in Canada.
So what does all this say pointing forward into the next 3 months of the year and into 2026?
Very hard to envision that it will pick up. We know that the Bank of Canada has cut rates quite a bit. They're not going to do so more, we think, at least for the next 6 or 12 months. So that means that purchasing power in terms of borrowing is not going to improve so much. People that are impacted by trade uncertainty, we don't think, unfortunately, that this will be alleviated anytime soon. So consumers are still going to be cautious. At the same time, business investment, we think, will remain somewhat weak. So that's another reason for the labor market to stay on the soft side. But I want to put that into context. There's a lot of emphasis on the negative here. This is not a recession. The unemployment rate, I'm saying it's relatively high. This is not an unemployment rate at recessionary level. There's no widespread layoffs. So it's unfortunately just a situation where growth will continue to be weak, but muddle through.
That was Dominic Lapointe, Director of Macro Strategy with Manulife Investment Management. Well, celebrity collaborations helped The Gap top expectations in its latest quarter, and we'll find out more from the company's CEO. That conversation is coming up right after the break. Shares of The Gap are trading higher after the clothing retailer reported a beat on sales and profit in its latest quarter. And for more on the results and the company's plans for the all-important holiday season, our partners at Bloomberg Television spoke with Richard Dickson, CEO of Gap Incorporated.
We've had consistent strength from our consumer behavior that we're winning, actually, with all income cohorts. When you look at the overall sales, comp up 5%. That's the 7th consecutive quarter of positive comps for us. Our leading brand, Old Navy, the largest brand, delivered an outstanding quarter. We were up 6%. Gap up 7%. Banana Republic up 4%. Gross margin exceeding expectations. So from an overall perspective, what we see and are proving is consistency in the context of our strategy and our playbook. As we look at consumers, we do see the consistency and strength with our customer behavior. And we've been winning with all income cohorts, as you could see from the differentiation in our portfolio. We saw equal growth across low, middle, and high. And while we're seeing, external data points to macro pressure, particularly on the lower income consumer, our customers are finding our price, our value, our style breaking through the competition. And ultimately, we're very excited to be winning in the marketplace, giving us a lot of confidence as we head into the holiday season.
Yeah, talking about the holiday season, how robust do you expect it to be? How is it coming along? And how much are consumers resilient, even in the face of price increases?
Look, holidays come every year. We're off to a great start. We have great activations that are planned this holiday. In particular, I'm very excited about certain categories: denim, sleepwear, fleece. These look really strong. Our value proposition, our marketing executions. Hopefully, you've seen some of the creative. When you go online to our sites, we're well positioned to serve our customers wherever and however they choose to shop. We just, for example, Old Navy did a partnership with DoorDash, which provides convenience for tens of millions of users. Our stores are ready, our teams are fired up, and we're looking to a strong finish to the year.
So, Richard, I expect you actually coming on and dancing to Milkshake in the background, because I hear you talking about some of the cultural relevance, and I wonder how much the battle for cultural relevance has been front and center for you about that viral ad. How much are you looking to new partnerships, new types of advertising as a way to really drive Gap strategy?
Cultural relevance is a very important part of our playbook, and we talk about relevance with revenue. You can have relevance but not revenue, and so the key to success is when you have relevance that drives revenue. And collaborations do help brand relevance. Now, it has to be the right collaboration and a win-win methodology, but it does do a really good job broadening its consumer base when it's done well, and continue the drumbeat between bigger and larger releases. So to stay in the cultural conversation, Gap brand has launched over 13 collaborations that continue to just drive excitement and surprise. But what I will say is that these are very precise, and as I said, need to be win-win and authentic to the customer. They do attract different audiences. In the Cat's Eye case, we did an extraordinary job continuing to introduce and discover Gap to Gen Z, which has been a really exciting segment for us. We got 8 billion impressions, 500 million views for the Better in Denim campaign. It was literally a global takeover, and it's become one of the brand's most successful campaigns to date.
Yeah.
We drove incredible traffic and, of course, double-digit growth in denim.
I have to ask, Richard, was this a direct response to American Eagle's Sydney Sweeney ad?
Look, I think the fashion industry is proving creativity, and competitively, we love the fact that there's lots of different conversations around fashion and particularly denim. We are front and center with our strategies. We did a Better in Denim campaign that was specific to Gap, expressing our originality and to some extent, sometimes it's convenience and sometimes it's ironic. But I think in the context of the denim dialogue, we certainly had our fair share of goodwill.
The denim wars continue, Richard. We just have just about a minute left. I am curious, going forward, how much you are seeing sort of that tariff-related impact on pricing, how much has already been factored in, and how much going forward you expect to still have to pass through?
Well, I would first call out our team. We have done a great job with our mitigation plans, which we've shared many times. It's been focused and thoughtful, making adjustments to sourcing, manufacturing, our assortments, and many other actions. And all of those actions were designed for the reaction of our consumer to continue to have our value, quality, and style portrayed, which is most important. The third quarter tariff impact was 190 basis points, but that was in line with our expectations. And despite this, we actually exceeded our gross margin outlook, which was driven by top-line momentum, less discounting, better regular price sell-through. So we're going to continue to pursue our mitigation plans, but we remain focused, most importantly, style, quality, and value for our consumer.
That was Richard Dixon, CEO of Gap Incorporated. Coming up, we've got 10 stock picks for the year ahead, including one AI pick. That's right after the break. Welcome back. Once a booming season, Christmas tree sales are now falling as trade uncertainty with the U.S. dampens demand. CTV's Paul Hollingsworth has more in this report.
For Christmas tree growers, this is always the busiest time of the year. Freshly cut trees are sold and shipped in time for December 25th. However, there are warning signs the industry could have a tough December.
The business is going to take a huge hit.
Colin Hughes ships more than 150,000 trees across Canada and around the world. His usual exports to the U.S. are down roughly 50% this year.
Down the eastern seaboard especially, there's I would say a nervousness.
According to Hughes, the trade war between Canada and the U.S. has pushed customers away from purchasing his trees.
General census that I was getting, and in fact, some of them said, like, we can buy $300,000 worth of trees from you, which is great, but if a tariff comes on to them the last minute, it costs us an extra $50,000 in tariff, that's our profit.
The Christmas tree industry represents big business in Nova Scotia, generating more than $50 million in revenue while supporting thousands of jobs. University professor Dan Shaw says American customers are likely managing risk during a time of economic uncertainty.
People act not necessarily always on data, but on perception, and having instability of those relationships impacts people's purchasing decisions.
Colin Hughes says a drop in Christmas tree sales to the U.S. will impact his bottom line. But there is possibly some good news. If fewer trees are sold in the U.S., more trees could be available for sale here in Canada.
Orders are down this year, so there should be a surplus of trees locally.
Hughes hopes tree prices in Canada will stay the same as last year, with a greater variety for shoppers to choose from, which could help boost his business. Paul Hollingsworth, CTV News, New Ross, Nova Scotia.
Well, the markets have been a bit wobbly of late, and how is that influencing which stocks top investors are picking for 2026? Earlier, we sat down with BNN Bloomberg's contributor John Ehrlichman, and John is the host of the investing channel Ticker Take on YouTube. Here's more on that conversation.
We're coming to the 2026 outlook a bit early, in part because of where we are in the market cycle. You said it, it's been wobbly. A lot of people trying to figure out if these growth stocks have run as far as they will. Should they be shifting in defense? But what if I miss out on the opportunities of growth and this is just a blip? So we spoke to a whole bunch of BNN Bloomberg regulars and really smart thinkers, in particular people who, when we were on Ticker Take a year ago asking them what they liked, they ended up getting some pretty good picks. So we went back to the same group, and it's kind of a mixed bag in the sense that people still are craving growth, but they're also leaning a little bit more into defense. Let me explain that. You've got people like John Zechner, who still likes a growth name like MDA Space, but he likes it because they've had some setbacks. So it's not as pricey as it might have been a couple of months ago. Teal Lind, a longtime BNN Bloomberg guest, who likes a company like Pinterest because it's a growth stock, but the valuation is more attractive than some of the other tech companies. So that's the theme I saw with growth. And then you've got other investors who are leaning into defense. Andrew Pink of LDIC likes Exchange Income, just because they've got a very steady, Eddie, predictable business tied to aerospace. Greg Newman of Scotia McLeod likes a telecom like TELUS, just because he thinks there's an opportunity to have more like a single or even a double rather than having to get to a home run.
Yeah, it's quite the mix, though, isn't it?
It is. Yeah.
Various sectors on this one, so you can kind of have a good balance here. You went out of order with me, so I lost a couple of the other ones that you were following. Tesla's in there as well.
Yes. Well, this is interesting because on the AI front, like, I think if you ask people, are you still picking AI names? There's different components. So Kim Bolton, longtime tech watcher and BNN Bloomberg guest, he likes Tesla because of all the parts of where the company could be headed, including AI. And then there's the power theme overall. Like, we spoke to Sam Stovall of CFRA, and he said, when you've got an up year, like we're having this year, it's quite common in the next year for the top three sectors to continue to outperform. One of those groups, utilities, which is why he likes a company like NiSource, which is feeding into the AI boom. There's all sorts of other AI companies that sort of came out in the conversations we had. A lot of them, though, fit into that power theme. Doug Clinton, a tech watcher, likes First Solar, a company that is, as the name suggests, all about solar, which maybe got a little less attention than natural gas or nuclear this year. So I think everyone's just looking for the stuff that maybe hasn't run as much, that still has a compelling thesis around it.
Okay, and have we got all of the, did you get Agnico Eagle Mines? Let's talk about
Yeah, I think we should probably talk about gold too, right? Because it's been an interesting year in the sense that you had the tech excitement, but you also had the gold excitement, and then the gold came off its peak. But David Burrows, a barometer, Roger, still likes Agnico, which is a company that he talked with us about on Ticker Take a year ago and did very well. A, because he thinks the bull run for gold is going to continue, even if it has a pause point. And B, because interestingly, in the case of Agnico, the last time we had a gold bull market, this was a star performer, and he likes the management team, and he likes the fact that the cash flow picture has improved dramatically based on what they have to produce at, their cost, and where gold is today. And also just they're predictable. They haven't cut their dividend in more than 40 years. So you've got a nice round picture of different stuff people are thinking about as we move into 2026. We'll see if things remain wobbly in the market, as you mentioned, for the rest of the year.
Yeah, it feels like, though, there are opportunities, because a lot of people think this might be overvalued, but there are opportunities out there if you look.
Yeah, and I think that even this week, when you think about there's some compelling investors making a case against AI stocks, and then when the head of NVIDIA explains the roadmap for where we're going, I think it's going to be hard for everybody to get off the AI train. But I think one of the themes that is very clear heading into 2026 is that people like the idea of still getting good value for what they're buying, and maybe that will be more of the litmus test. Companies have to keep proving that they can deliver, or they might see a little bit of a shakeout in some of their stock performance.
That is BNN Bloomberg contributor John Ehrlichman, and John is the host of the investing channel Ticker Take on YouTube. Market Call is coming up next, and today on the show we have David Driscoll. He is founder and president and CEO at Liberty International Investment Management, and we'll be taking your questions on global equities. So that's coming up next. We'll take a quick look, though, before we leave, at how the markets on Bay Street and Wall Street are trading today. Trading up right now, flipping between gains and losses today in the U.S., and this is mostly because of uncertainty around AI, uncertainty around potential rate cuts next month by the Federal Reserve. The TSX reflecting some of that uncertainty today as well. But at the moment, you can see all of these indices trending up. And thanks for watching Morning Markets. We will see you tomorrow.